Hey everyone, welcome back to Corporate Decoder. Today, MMTXW just filed an 8K announcing a business combination, and I am seeing one red flag that really matters. Quick note, this is not financial advice, just my take on public filings for educational purposes. This filing is all about a company called Miluna Acquisition Corp forming a merger with another company, and it signals a big transformation phase. But there are key details in here that investors should pay close attention to. So what we have here is Miluna Acquisition Corp, which is a special purpose acquisition company, or SPAC for short, announcing a major agreement to combine with Kukugan Invest and CADV Ventures. This is a pretty standard move for a SPAC like Miluna. Remember, SPACs are created just to go out and find a private company to merge with, essentially taking that private company public through this merger process. The core of this filing is the business combination agreement. This is the big contract that lays out all the terms for how Miluna and Kukugan Invest are going to come together. It is effective as of the 23rd of April 2026. The companies involved are Miluna Acquisition Corp, a Cayman Islands company, Kukugan Invest also from the Cayman Islands, and CADV Ventures ESA from Poland. It looks like Kukugan Invest will merge into Miluna, and then CADV Ventures ESA will become a subsidiary of Miluna. This sounds a bit complicated, but the end goal is to make CADV Ventures SA a publicly traded company on the stock market. Now, let's talk about the money involved. Miluna is agreeing to issue new shares to Kukugan Invest. The total value of this deal is set at $250 million. Miluna will issue a number of Class A ordinary shares to Kukugan Invest. The price for these shares is set at $10 each. So, if you do the math, they're looking at issuing about 25 million shares to Kukugan Invest as part of this deal. This is a significant number of shares, and it is important to understand how this impacts existing shareholders. There is also mention of Class B ordinary shares. These are being issued for a nominal amount, meaning practically no money, to a specific individual. What is interesting about these Class B shares is that they have a lot more voting power. Each Class B share gets 15 votes, which is a big deal. These shares are not convertible into Class A shares and have no economic rights, meaning they cannot participate in dividends or profits. They can only be owned by this designated individual and are not easily transferred. This structure can give significant control to one person even if they don't own a majority of the economic interest. Think of it like a super voting stock. Here is another critical part that often gets overlooked: the earn out. In addition to the initial shares, the former holders of parent ordinary shares, which refers to Kukugan Invest shareholders, could get up to an extra 5 million Class A ordinary shares. But this is not guaranteed. They only get these extra shares if the combined company achieves a revenue of at least $7 million for the fiscal year ending the 31st of December 2027. This is a performance-based incentive. If they hit this revenue target, these shares will be issued shortly after their 2027 annual report is filed. This is a common tactic to align the interests of the selling shareholders with the future performance of the combined company. It means that if the company does well, existing shareholders could see more dilution, but it also suggests confidence from the sellers in achieving these targets. The agreement also contains many promises called representations and warranties that each party makes to the other. Miluna promises things about its own operations, like being properly set up and having the authority to do this deal. The company California DV Ventures SA also makes promises about its business, its financials, its contracts, and its intellectual property. Parent Kukugan Invest makes similar promises. These are standard in such agreements to ensure everyone is being truthful about their situation. A key definition here is material adverse effect. This basically means a significant negative event that could hurt the business, its finances, or its ability to complete the deal. It is a way to protect parties if something major goes wrong that wasn't expected. Between signing this agreement and when the deal actually closes, both sides have to act in certain ways. They promise to use their best efforts to get the deal done. During this interim period, they have to operate their businesses normally. Miluna needs to keep up with its public company duties, and the company needs to provide its financial statements. Importantly, they've agreed not to look for or make other deals with other companies. This is to ensure they are focused on completing this specific merger. They also commit to working towards getting any necessary approvals from third parties and regulators. For this merger to happen, Miluna's shareholders need to approve it. The companies will prepare and file a registration statement with the SEC, which is a big document that includes a proxy statement. This proxy statement is what Miluna will send to its shareholders to ask for their vote on the merger. It will also give shareholders the option to redeem their shares, meaning they can ask for their money back instead of participating in the new company. This is a standard procedure for SPACs. Generally, the promises made in the agreement, like the representations and warranties, won't last forever. They typically end once the deal closes, unless they specifically say they need to be fulfilled after the closing. This means that after the deal is done, there is a limited window to hold someone accountable for breaking those promises, unless the promises themselves were meant to extend into the future. This deal has a lot of conditions that must be met before it can be finalized. Both Miluna shareholders and parent shareholders have to approve it. There shouldn't be any laws or court orders preventing the deal. The shares of the combined company need to be approved for listing on a major stock exchange, like Nasdaq. Also importantly, Miluna's board of directors, especially the independent directors, must have approved the deal. On the other side, for parent and the company, they need to confirm that Miluna's promises were true and that Miluna has done everything it was supposed to do. For Miluna, they need to confirm that promises made by the company and parent were also true, and that those parties have fulfilled their obligations. There are several ways this agreement can be called off. If the deal isn't closed within 9 months, either side can terminate it, unless the delay is their own fault. They can also terminate it by mutual agreement, or if a government authority puts a permanent stop to the deal. If either party seriously breaks the agreement and doesn't fix it, the other can walk away. If Miluna shareholders don't approve the deal, or if the stock exchange doesn't list the combined company's shares, that is also grounds for termination. If the deal is terminated, most obligations end except for things like confidentiality and who pays the costs. However, claims for fraud or willful breaches before termination can still be pursued. This is an important part for SPACs. Kukugan Invest and CADV Ventures are agreeing that they have no claim on the money Miluna has in its trust account. This is the money that Miluna raised from its initial public offering that is set aside to protect public shareholders. They are waiving any right to touch that money, which is good for investors who might be expecting a return of their capital if the deal doesn't go through, or if they choose to redeem their shares. Also attached is a sponsor support agreement. This involves Miluna Technology Limited, which is likely the sponsor of Miluna Acquisition Corp. The sponsor agrees to vote their shares in favor of the merger and grant certain waivers related to Miluna's organizational documents. Sponsors typically get a significant chunk of shares for a nominal price, and this agreement ensures they are aligned with making the deal happen. There is also a parent support agreement. This involves the shareholders of Kukugan Invest. They are agreeing to support the transactions and grant any necessary waivers related to parent's organizational documents. This is similar to the sponsor agreement, ensuring that the main shareholders of the company being acquired are on board. The filing also mentions that at the closing of the deal, there will be new agreements, a registration rights agreement, and a lockup agreement. The registration rights agreement means the combined company will have to file documents to register the resale of certain securities. This allows shareholders who received shares in the merger to eventually sell them on the open market. The lockup agreement typically restricts certain shareholders from selling their shares for a period after the merger to prevent immediate dumping of stock. This section refers to a press release that was issued on the 27th of April 2026, a few days after the agreement was signed. This press release is what likely announced the merger to the public. It is important to remember that information furnished in this section is not considered officially filed with the CC in the same way as other parts of the report, meaning it has slightly different legal implications. This part is really just a standard legal disclaimer. It warns that many statements in the report are forward-looking. These are statements about the future, like expectations about revenue, growth, or the success of the merger. They use words like believe, may, will, and expect. The disclaimer is there to say that these are not guarantees and that actual results could be very different. It lists many risks that could affect the future performance of the combined company. These are the usual suspects for SPACs: regulatory hurdles, failure to get shareholder approval, market conditions, and the ability to realize projected benefits. It highlights that things are difficult to predict and many factors are outside the company's control. This section tells people where to find more information. It reiterates that Miluna's shareholders will get a proxy statement to vote on the merger. It directs people to the SEC's website to find these documents and also suggests contacting Miluna directly. It also mentions that the directors and officers of Miluna might be considered participants in the solicitation of proxies, meaning they have an interest in the outcome and should disclose that interest. This is all standard procedure to ensure transparency for shareholders making voting decisions. Finally, this lists the exhibits that are part of this filing. The most important exhibit here is Exhibit 2.1, which is the actual business combination agreement itself. This is where all the nitty-gritty details of the deal are laid out. There are also other supporting documents like the sponsor support agreement and the parent support agreement, which we touched on. The press release is also included here. So, looking at this entire filing, what is the story Miluna Acquisition Corp? A SPAC is merging with Kukugan Invest and its subsidiary CAD Ventures SA. This is their way of taking CAD Ventures SA public. The deal is valued at $250 million in shares. There are some interesting elements like the super voting Class B shares, which concentrate control, and an earn-out clause that gives additional shares based on future revenue performance, which could lead to significant dilution if achieved. The agreement is packed with conditions and termination clauses, which is typical for these types of mergers, for investors. The key things to watch are shareholder approval, the stock exchange listing approval, and the exact terms of the earn-out shares. The earn-out in particular could be a major factor in future stock dilution. If the company hits its revenue targets, a lot more shares will be issued, potentially driving down the price. Per se for existing holders. Historically, SPAC mergers can be very volatile for the combined company's stock, often seeing significant drops in the months and years following the merger, especially for companies in less established sectors. For example, many SPACs that merged in 2020 and 2021 have seen their share prices fall 70 to 90% from their post-merger highs. The structure with the high voting Class B shares is also a point to note. While it doesn't directly affect the economic value of the class of shares, it means that control of the company might not align with the economic ownership. This can sometimes lead to decisions that benefit the controlling shareholders over other investors. Overall, this filing marks a significant step for CAD Ventures ZA to go public. However, the details around the earn-out and the concentration of voting power are crucial for anyone considering an investment. The risk I am watching is the potential for significant dilution from the earn-out if performance targets are met and how the market will react to the control structure. What I am actually looking for is strong execution and profitability from the combined entity to justify the potentially dilutive share issuance. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my tape. Stay decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description.